Hey everybody, my name's Joe Pivarunas. I'm the founder and managing editor of Nanalyze. We're a boutique media and research firm covering disruptive tech stocks for a broad audience of retail and institutional investors across the globe. Today we're going to talk about a company called NanoXplore. They're involved in the business of graphene, as you can tell by the cover slide here. And the question we've asked here is, where are the organic revenues? Now, the reason we're covering this company is because we covered graphene stocks not too long ago, and we do this about once every couple of years because there never seems to be any traction in that space. So I know that a fair number of you may not be invested in graphene or have no desire to, so I wanted to just touch briefly on how we go about choosing topics that we cover in our research pieces and also in these videos. So I think at the top of the list would be stocks we're holding. So we actually have a real life portfolio of 38 tech stocks. And then we have another portfolio with 30 dividend growth stocks, and Nanalyze is all about the tech stocks. Then there's stocks we like or others might like. And then also SPACs. These are quite popular. So we've covered all, let's say most disruptive tech SPACs. And then you have popular tech stocks, and I use the word stocks here because this would refer to companies that everybody seems to be getting on board with, but they're clearly rubbish. So for example, Microvision would be one of those. And some of the more sophisticated investors that we have subscribed to our service would probably ask, well, what are you wasting your time doing covering stocks like that? And that's mainly because we're able to attract investors that may not understand some of the pitfalls out there, generally newbie investors. And it's great to attract people like that and to educate them about some of the dangers of investing. And then, of course, we have stocks that you all request, people that support us. That's what we want to move towards. So the people that financially support us, we want to set up some sort of voting mechanism so that you can help guide some of the direction regarding topics. And then the question is, well, what about stocks that are clearly to be avoided? And I would think that the stock we're going to talk about today, in our mind, would fall into that category. This would be a stock that we would never consider investing in. But I think there's really some interesting lessons to learn today, no matter what level of an investor you are. And the topic today that we're going to cover relating to NanoXplore is about inquiring growth. So I put up a couple examples here that are interesting. Probably the best example when it comes to the SPAC world is Desktop Metal. So they moved to consolidate a very disparate space of metal 3D printing companies. I think they made 10 acquisitions in a single year, and one of those was a major competitor, X1. And what you have with SPACs are companies that get a lot of cash from investors very quickly, and then they look to use that to grow their businesses. Another example would be Rocket Lab. So they wanted to diversify outside of just competing with SpaceX for launch dollars. And then you have a company like Nano Dimension that, from our perspective, failed to, I think from any perspective, honestly, failed to successfully commercialize their own technology, which was 3D printers for electronic circuitry, more or less. They needed to pivot into something new. They got a ton of cash, somewhere in the range of $1.5 billion, and they're deploying that, trying to acquire some growth. So not a SPAC, but generally the same idea. So there's a couple assumptions I think we should make when we're looking at companies that get a bunch of cash and try to grow their business using that cash. So we would first say the acquisitions they make should certainly complement their core technology. That should be a given. We're not interested in conglomerates, right? We'll invest in 3M if we want to invest in a conglomerate. And then it should be an assumption that there's synergies to be realized on the cost side, and then additive growth on the revenue side. That means that if you purchase a company that's producing $50 million a year in revenues and you're already producing 50 million, then you would expect to have 100 million, and you would expect that to grow. And then this third point is about intangible assets, and that probably relates to companies like Teladoc that acquired Livongo for something in the range of 14 billion, and 12 billion of that was goodwill, which is essentially something that the accountants use to describe value which they can't quantify. And we all saw what happened to Teladoc stock when that goodwill was written down. We see that also in the cannabis industry happening as well. And it's in the cannabis, it's related to companies trying to acquire as quick as they can because others are trying to do the same thing to consolidate the space, and they end up paying very high prices, and they have to justify that by putting goodwill on their books. Now, let's talk about NanoXplore, okay? They're a graphene company. That's what they call themselves. And we have some questions around whether that label's appropriate, but this is a look at their revenues. And the last time that we checked in, they had minuscule revenues under $10 million a year. We don't consider that meaningful. This is in Canadian, actually. And we see here that in 2019, revenues soared. Why? Well, that's because they acquired a company called Sigma. And that acquisition explains about 85% of the revenue growth that you see in 2019. Now, they said something interesting here that's worth noting. They said if the combination had taken place at the beginning of fiscal 2019, in other words, if they brought that company on right then, Sigma's revenue contribution would have been $74.56 million. So right away, we should think to ourselves, all right, if that's what Sigma did in 2019, we would expect to see at least that much in 2020. Well, you can see in 2020 and in 2021 that neither of those years exceeded 2019, nor did they exceed what Sigma did in 2019. That's a problem. You shouldn't be acquiring a company that isn't growing their revenues. And that's just part of the story, because here's another acquisition that NanoXplore did. In 2018, they acquired this company called CEBO. And they said if we acquired CEBO at the beginning of 2018, the revenues would have been around $8.3 million. So what we can do is this. We can add the two. We can say, all right, CEBO's revenues in 2018 were 8.3. Let's assume they kept that steady. They didn't grow it. And then let's assume Sigma, we don't have to assume, we know Sigma brought in almost 75 million. Let's add those two together. We get 82.88 million. That's what we should see, at least assuming no growth, coming from NanoXplore following those two acquisitions. Well, we don't actually, as we saw before. Let's see, there's 82.88 million. And what do we actually get? We got what? Somewhere just above 60 million in 2020. Okay. To make matters worse, we go to 2021. All right. Starting with the 67 million that NanoXplore brought in, they made another acquisition that year, which brought in $8 million that was put on their books in revenues. So let's subtract that. All right. So we have the 67.62 million they realized. Let's subtract the 2021 acquisition contribution from this company called CSP. What do we get? We get $59.59 million in revenues versus the 82.88 that they should have realized from those previous two acquisitions, assuming no growth. We're already 2 years past that. We're assuming no growth, and they're still far away from where they should be. So this is very questionable. And the whole idea behind making these acquisitions is that they were going to take these manufacturing companies, they were going to apply their graphene magic, and they were going to grow revenues. Well, you can see here, this is taken from their annual reports. And by the way, this entire presentation and the accompanying research piece, which I will link to, or all the information used is taken from annual reports. We don't talk to company management teams and listen to their marketing spiels. They're trained to speak to the media. We don't talk to company management. We simply look at what they tell regulatory authorities. That's the ground truth. Now, what investors in NanoXplore need to be asking themselves is, what are you invested in? Are you invested in a graphene company or a manufacturing company? And you can see here that these are the three companies that they acquired that we talked about. One is operating in the market of composite products for heavy trucks and machinery. The other is doing manufacturing composite products from 3 wholly owned subsidiaries. The other is producing high precision and high quality injection molded products. So essentially they've pulled together 3 manufacturing companies, and then they've said, all right, we're going to take our graphene magic and we're going to use that in the products being produced by these companies and grow revenues. Well, they can't even manage to keep the same revenues that they had when they acquired these companies, much less grow them. So it seems like this is a manufacturing company with a graphene problem as opposed to a graphene company with a manufacturing problem. So that's one thing we noted. And then some individuals had brought up the fact that the stock price performance since the last time we covered this stock in a piece titled A Guide to Investing in Graphene Stocks. I'll link to that. We published that on June 14th, 2020. And since that piece, the share price of this company has increased 105%. Now, we don't pay much attention to short-term share price movements, but we just wanted to touch on this because it's kind of interesting. So the first thing you need to do is compare that to the benchmark, which is the TSX Venture Composite Index. That's the exchange this company trades on. That exchange appreciated by 45% over the same time frame. So you can subtract that and you still have a 60% growth. But when you adjust time frames, it also gets interesting. So you could say, all right, over the past 6 months, NanoXplore stock has fallen 59% versus an index drop of only 16.5%. So what appears to be the case is that the stock was, and we can see just based on the chart, was hyped up for quite a while, and then now it's corrected significantly, and you have a lot of bag holders perhaps. Well, bag holders isn't a correct term to use because you're only a bag holder if you end up holding shares that don't have any value. So, well, you have a lot of people that bought into that hype and then now are concerned about the stock that they purchased perhaps on a whim because graphene's an exciting story. So when you analyze this company, you need to think about what you're invested in. Are you invested in a company that gives you exposure to graphene or manufacturing? And the other thing to note is all along the way, we see outstanding shares for NanoXplore increasing. And this chart is very simple. It just shows the shareholder dilution that's taking place every year as the company issues shares to survive. This is just, we see this story played out time and time again. So is this a graphene company that's dabbling in manufacturing? Or is this a manufacturing company that released some graphene-enabled products that their customers don't care about? Well, certainly seems like they're not able to just maintain the revenues from the companies they're acquiring, much less grow them. If we just take that baseline, the 3 companies they acquired, at a minimum, they should be doing $100 million per annum, and they're right back where they started in terms of the revenues that they acquired. Once they hit that 100 million, and they're far from it, but once they hit that, then they need to start growing that using graphene and showing us that graphene is allowing them to produce superior products. What we suspect you might see is a lot of what's happened the same thing over. So you'll see shares continuing to increase, and you'll see acquisitions made to show revenue growth. And that's certainly something that investors need to be paying attention to here. This isn't a stock we would ever consider investing in at any price. It's very opaque. There's not a lot of information in the financials that they file. And certainly even in the investor decks, it's very vague. This is not a company we would ever consider investing in. So please put your comments in the comment section. We'll address them there. Make sure to subscribe to our channel. We'll be putting out more videos over time. And thank you very much for taking the time to listen to this video today.